All right, so we have just finished the debt and interest schedule, and as with all other steps, I've saved it as step 5. And again, saving these along the way so that ideally you want to do these steps yourself, but invariably, when I've taught this class in the past, people do get stuck with specific formulas, and sometimes they just want to see if they've done something correctly, which is why I'm continuing to. So now that you've made the debt and interest schedule, you can go down to earnings before taxes in your operating model setup. And as you can see, for interest expense, I'm just going to magnify this a bit, and the shortcut for that is Alt-VZ. And if you hit tab and let's say hit 100%, the screen becomes slightly bigger. So I'm going to link this interest expense to and again, just to really go over the shortcut slowly, I'm in cell I-74, I hit the equals to sign, and then control page down and find my way to debt and interest, use the negative sign to indicate that this is an expense, and select the cell I-22. In this case, I ended up using the mouse, which in this situation was more efficient just because where the mouse was. But let's say if I want to go back to my to not using a mouse, just using the right arrow key will activate this, and even to become a bit more efficient with keystrokes, the control key and the arrow key will help. So here's a bit more. I realize I'm getting pedantic here, but every keystroke that you minimize is going to add up, and in finance, compounding is a pretty important concept. It's like if you keep doing these small improvements in the way you do work over time, it compounds into really big results. So okay, so equals to negative sign, control page down, find our way to debt and interest. The right arrow key will activate the cursor, which you can see, and then the control and down key is going to make it jump. See, and this is what I wanted to select, and right now it is color coded red, even though it should be color coded green. So I'm going to copy the formatting from cell H74, hit Alt EST to copy the formatting, and then copy this to the right. Interest income we cannot calculate for now because we need to finish off the balance sheet. This is the whole circular reference conversation that I had earlier. For now, just input a fixed number. We're just going to input 1,000,000 or 1,000 for now, and this brings us down to earnings before taxes. Now, our next step is populating the tax schedule. Since we are performing a very basic calculation over here, we're just going to take a 35% tax rate, which 30 to 35%. The reason I'm not getting into a whole lot of detail with the tax schedule is that taxation varies tremendously depending on the type of business and the geography you're in. Sometimes sales tax will be applicable, sometimes it will not, sometimes there will be certain withholding tax that will be applicable. And again, students often ask, how detailed should I go into my tax schedule? And the answer is, again, it depends. Why are you building a financial model? If you're building a financial model to figure out what is an optimum taxation strategy with regards to how you report your financial statements, that's a very different perspective of building a financial model. If you're building a financial model to advise an investor whether something is a good investment or not, well, that investment should not be based on what the tax laws are. Or generally, it should be a good business and taxation should be a secondary consideration. In our case, we're advising an investor. And so we are going to take a very high level assumption, which is that we're going to assume that tax rate is 35%. and we are going to color code it blue because it's an input. And we are going to link earnings before taxes to operating model step 0. Copy this to the right. And for taxes payable, we will just simply multiply this 35% by earnings before taxes. And now some of you will be noticing that I've got RS or rupees appearing here, and I've got the dollar sign appearing over here. If this is irritating you and you want the dollar sign to appear over here, one quick way is take the cell in H14 and copy the formatting, Alt EST, and then Alt HFC, change the color to black, and then copy to the right, and then you'll have the formatting. If you don't want to do that and you want to do this a bit more directly, you can select the cells where you have a dollar sign, press Control 1 to enter the editing space, hit Tab, and where you see this next dollar, this needs to be replaced with an RS and space between it, and that's going to fix the formatting. So we now have completed the tax schedule. You may be wondering why I didn't just calculate tax in my operating model step 0. The reason for that is keeping a separate tax schedule generally helps, because when you are first building a model, you want to keep some flexibility. Taxation is generally something that you will build upon. When you're building the first iteration, you're not going to go deep into the tax consideration. But as you go deeper into a transaction, needless to say, tax is going to be driving some of the decision making. So keeping a separate tax schedule is generally helpful. And so I want to take you back now to the Cadmus modeling framework. We used I would say, a common sense approach to ask questions like, how does an airport make money? We saw a video and we figured out that airports charges landing fees, handling fees, and embarkation fees. We came up with some price and volume drivers, developed a forecast. We used some historical averages to calculate or forecast the operating costs. And once we were down to EBITDA, we knew that to get to net income, we need the depreciation schedule, the debt and interest schedule, and the tax schedule. And again, to think about these schedules, it's like work your way backwards from EBIT DA. To get to EBIT, you need DA, which is depreciation amortization. To get to EBT, you need interest, which is the debt and interest schedule. And to get to net income, you need the T, which is the tax schedule. And so that's generally how I think about the sequence of populating schedules. Once you have got the income statement down, you are now in a position to start moving towards cash flow, and particularly cash flow from operations. And for that, you are going to need the working capital schedule, because again, going back to the formula for cash flow from operations, it is net income plus non-cash expenses like depreciation plus changes in net working capital, which is changes in accounts receivable and inventory and changes in accounts payable. So our next step now is to populate the working capital schedule. And as before, I'm just going to save this as financial modeling step 6, and we are now going to start our journey to go from, so we went from EBITDA to net income. Our next journey is going to take us from net income to cash flow. One quick thing I want to do just to make a point about model architecture In my financial model step 0, you're going to notice that I'm keeping my income statement, balance sheet, and cash flow in one sheet. And since I've now made my operating model, I'd like to now link or populate this income statement from operating model step 0. So just to link it, I'm going to go on cell I12 and find the landing fees number in operating model step 0, and then just copy right, copy down, and copy those formulas. Because the rows are spaced exactly the same way in financial model step 0 versus operating model step 0, simply copying and pasting the formula from one cell to the next cell allows you to populate this financial statement, which is basically what we've done. And our next step is to start populating this balance sheet, right? Or rather, we need to think about what are all the schedules we need to populate this balance sheet. We have the gross property, plant, and equipment and non-current assets forecasted already in the depreciation schedule. We've got the secured debt and unsecured debt already forecasted in the debt and interest schedule. But we haven't done working capital and we haven't done shareholders' equity. So let's first do that before we start our journey with populating the balance sheet. So working capital. Before we just begin talking about working capital, let's talk about at a very high level what is working capital. It's delays in payments. It's think of it as the income statement, as I mentioned earlier. It tries to capture exactly accurately what went down in a given period. So let's say in a given period, let's say you are a English tutor and you have a agreement with your student that you are only going to get paid after you have delivered all your services, and that is going to happen. So let's say you've got an arrangement that you will teach your student for 3 months and 3 months later you're going to get paid. So at the end of month 1, you will have income reported on your income statement, but you would have received no cash, and instead what you will be booking is an accounts receivable. In month 2, again you will have some income and your accounts receivable will be increasing. In the 3rd month, you will again have some income, but because you will have received the cash for 3 months, your accounts receivable will go down to 0, right? So the part I want you to just internalize is that when accounts receivable declines, or when working capital on the asset side declines, cash increases. And conversely, when working capital on the liability side increases, cash increases. So I mean, here's how you can think about that. Let's say you told your student that no, I'm not going to first do the services and then get paid. You need to pay me in advance and then I will deliver the services. In this case, you have a payable. You have received the cash, but you have not performed the services as yet. And so every month that you end up performing the services, you will be recording income, but your payable balance will be going down, but you won't be receiving any further cash, assuming you still have that 3 months deal. Keep that in mind as we try to build a forecast for working capital. And the working capital schedule at a very high level tries to figure out, on average, how long does it take to get paid for services performed. And so in this case, we're going to take the receivables from customers. These are the receivables related to handling fees, embarkation fees, and landing fees, handling fees, embarkation fees, and how long does it take to collect those payments. And so at a very high level, you take the annual revenue as a percentage of, or you take accounts receivable as a percentage of the annual revenue, and then you reflect that in number of days. So to your first task over here is going to be to calculate the accounts receivable days. And so to do that, you will say, okay, accounts receivable as a percentage of revenue is roughly 25%, but we want to reflect this in days. And why we want to reflect this in days, it just helps us. It's an easier picture to visualize that, oh, okay, it's taking 82 days. It took 82 days or 82 days in 2006 to collect our payments. It took 76 days from the time that we billed our customers to collecting our payments in 2007. And it took 73 days to collect our payments, and so on and so forth. Similarly, with inventory, inventory will be tied to operating costs, because this is how many spares and parts and I would say stuff that you're keeping in your warehouses to ensure that when something breaks down, you have it readily accessible. And so the inventory is going to be tied to operating costs, but again, we're going to represent that as days, because taking an assumption on days is easier as opposed to percentages. You could take a view. I mean, you may disagree with that as well. You could say, no, I can also just forecast accounts receivable as a percentage of revenue, and then just take that percentage and then use that percentage to develop a forecast. That's totally fine. But using days is just a bit more intuitive. In some of the cases, I will be using a percentage just to drive home that point that this is totally okay. So we're going to take current assets as a percentage of revenue, and this is totally okay as well. It's I mean, I've come across both sets of people. Some people have a really hard time digesting that, I mean, what do you mean assets as a percentage of revenue? It's a hard concept to internalize. Whatever works for people you're working with. At the end of it, it's an assumption that you're using to get the engine of the financial model started. So let's keep going and build out the accounts payable days now. Payable days we're tying to operating costs. So we're going to say that payables as a percentage of operating costs expressed in days is 33. So on average, we spend about 33 days or about 30 days to pay our suppliers, or to pay our employees, or to pay people who we owe costs to. And then for accrued expenses and other non-current liabilities, we will just take it as a percentage of operating costs. And back to our favorite anchoring exercise. I want to write one formula, copy it to the right, copy it down. So I want you to think about where will you put the dollar sign. And if you answered that it's before the number 13, then you got it right, because we want to be able to copy this right and then copy it down, and then make sure that row 22 moves down, but row 13 does not move down, which is why we have anchored row 13. And now that we've got these historical ratios calculated on working capital assumption, we can use these historical assumption to build a forecast by saying, let's just take a moving average of each of these days, and in this case percentage, and just use that average to now calculate forecasted working capital, because see, we already have the total revenue and operating costs projected using our income statement. And now that you have assumptions on the working capital days, you can use this assumption on working capital days with the forecasted revenue and operating costs to have to make a projection for your accounts receivables and your accounts payables, or basically your working capital line items. All right, so again, you'll see the formula. Don't get too hung up on these formulas that I've written. While they are helpful, to see, try to verbalize to yourself, how are you calculating? So try to verbalize to yourself, if I want to calculate accounts receivable balance in 2019, I want to take the days outstanding expressed as a percentage of the year multiplied by the revenue, and that is your accounts receivable balance. And now at the same time, you want to ask yourself that, okay, how do I ensure that when I copy this to the right, I don't run afoul? Well, you want to make sure that this days in a year is anchored. If days in a year is anchored, when you copy this formula to the right stuff is going to move. Yeah. Similarly, with inventory, you will take inventory days expressed as a percentage of the year multiplied by total operating costs, and make sure that you anchor days in a year, copy to the right. Similarly, with forecasting other current assets, that is simply a percentage of total operating costs. And so in this case, now you don't need to project days. You can just take the percentage. And this is where people generally start wondering, what's the point of even forecasting working capital in days? And it goes back to contracts. It goes back to how humans agree on certain terms. It goes back to that example of you being a teacher, or you are providing a service, you being a consultant, saying, hey, I will bill you a certain amount in advance, and the remaining I'll get paid once the service is delivered. That's how contracts end up getting agreed upon between two parties. And it's easier to write down that, I will make payments 30 days in arrears or 60 days in arrears, as opposed to saying at no point will working capital be more than 20% of revenue in a given year. And so that is a really important piece, and this is an exercise that I would make my team do a lot, on how to go from financial model to legal contract, and how to go from legal contract back to a financial model. The more you practice, the more you think deeply, more fundamentally about models, the easier time you will have going back and forth. And again, these are some of those finer points. In my introductory video, I talked about that. The journey of the modeler is quite profound, and this is the journey of the modeler. That as you get into modeling, you start developing these insights. And it's the analogy I can tell you is that you going on top of Mount Everest on a helicopter ride versus you climbing Mount Everest will be two very different experiences. You may get to the same summit, but the person who climbs Mount Everest will be a completely changed person by the time they're done climbing Mount Everest. And building a financial model is certainly not Mount Everest, but it's a journey, and an important journey, one that creates some pretty meaningful insight. So I'm obviously a very big fan of decision makers building models themselves. I think outsourcing analytical work or modeling is not a great idea, but I digress. Let's come back to accounts payable. So similar idea. To forecast accounts payable, I will take my days that payables remain outstanding, expressed as a percentage for the year, and multiply it by the total operating cost. I will do Alt H A C to central cross selection, and see, I did not anchor. Which is why I got these errors. When I anchor, that gets fixed. Similarly, I will take my operating costs as a I already have accrued expenses expressed as a percentage of operating costs. I now need to do the opposite, and this is going to be probably your last anchoring exercise. So I want you to anchor. I want you to figure out which cell you're going to anchor and how. So you want to anchor the row 13, because when you copy this box down, you don't want row 13 to move, but you want row 32 to move. So I can tell you that of all the tricks that will help you accelerate, anchoring is number one. I would say anchoring and keyboard shortcuts, these are probably my 1 and 2 that really make a difference. And over time, anchoring will become intuitive for you. Right now, it's going to be a bit of a struggle that, is it the letter? Is it the number? It's okay to do trial and error. It's totally okay to, write a formula, copy it to the right, see it not working, and then fix it. Excel is a very forgiving program, which is part of the reason it's a bit problematic as well, because everyone knows how to use it, and that's why building standards inside companies on how to use Excel tends to be difficult. And that's why spreadsheet quality in most companies it's not very good. So now that we have our working capital schedule, we are in a position to move on to our shareholders equity schedule, because this is actually now coming to the I would say the basis of your client SAS Capital putting in the money, right? Your client hired you to figure out whether this investment makes sense or it doesn't make sense. And that's obviously a very vague ask, but you also not only want to advise them on how much money to put in, but also at what price. So what you have on this tab of valuation consideration is a very high level analysis of how many shares would get issued to SAS if they invested 30 million rupees at a price of 2.8 rupees per share. And obviously, since this is now laid out with the right best practices, you can also see that if you were to change the price, how does everything else change? And so currently we're just assuming that at 2.8 rupees per share, SAS will invest 30 million rupees and get about 10,000 shares, which works out to about 9.6% of the company. And that's kind of in line with where SAS likes to play. So don't get too hung up on, is 2.8 the right number? We will figure that out once we build the dashboard. Once we build the dashboard, we'll figure out what are the right ranges to be playing with. Again, going back to the purpose of the financial model is to help create a visual of this cone of possibility. And as you are trying to put the contours of that cone together, don't get lost in individual exercises. And again, it's like here, I can see many a team not completing a model, getting stuck in an impossibly long exercise on, what is the right valuation perspective to think about. It's too soon to be having that conversation. Get the engine going. And then you'll start figuring out, what is really the right metric to be playing with. I can't emphasize that enough. It's important for you to build that map of that forest before you start figuring out which parts you're going to investigate. And that is actually one of the biggest challenges of a modeler. A modeler has to always make these judgment calls between getting the model completed or doing a deep investigation on a particular issue. I will always urge you that for your first iteration, go quickly to get the model completed, and then you can start manipulating an existing model to layer in a more functionality, more perspective, more and more changes. So for now, take this valuation sheet as a given and use it to populate the shareholders' equity schedule. So in this shareholders' equity schedule, we want to link in the shares that were issued to SAS, which is 10.7 million, and we want to also calculate the additional paid-in capital. That's just going to be the total price that they paid minus the shares that were issued, because in this case the par value of each share is 1 rupee. These two things collectively are summing to the total investment amount of 30 million. If you don't like, if you're getting lost with this term additional paid-in capital, you can just think, you can actually just completely not be bothered by this split between shares issued and an additional paid-in capital. You can just keep it as one line item and have it as investment from SAS and be that, and call that 30 million. To finish off our shareholders equity schedule, we also need to have a assumption on dividends paid. Airports and power plants and such infrastructure type investments are cash yielding investments. So historically, we can see that this airport is paying out about 25% of net income as dividends, and we're going to assume that they continue to do so. We're going to assume that 25% of net income continues to be paid as dividends, and we'll do Alt H9 to remove this decimal. So we now link dividends paid to the calculation below. Alt HAC, sum all of this above, and copy this to the right. Alt HAC, and this is our net income. This is the ending equity balance. It is we also need the starting equity balance, which we did not put in over here, and we're just going to do that now because otherwise. So I inserted a row and I said I need my starting equity balance. My starting equity balance is just the previous year's ending equity balance, and now all of the summed up will be the ending equity. And then similarly now, now we have the right starting and ending equity balances, because I had calculated the change in equity, not the balances. Now that I have these schedules set up, I can finally, I've got all of the schedules in my that I need to actually populate my income statement balance sheet and get my balance sheet to balance. So this is going to be the last and final step before we get to a balanced model. Folks really tend to start getting concerned when you're getting closer to a balanced model. An unbalanced model is a very common challenge that exists. I'll show you a couple of techniques that you can use to always get a model balanced, or to always ensure that a model is balanced. But before we do that, let's just populate this balance sheet. So to populate this balance sheet, before I start populating, I'm just going to save where we are as step 7 and start populating. And some of you may be thinking, oh, I can just, this is a bit too mundane. I'm not really sure if I want to go through all this numerical exercise. I think it's a good idea if you do that, because it'll build speed. If you already feel you have speed and you don't necessarily need the practice, that is your judgment call to make. As I said before we started the course, when the student is ready, the master emerges. So it's entirely up to you. What I'm doing here is just linking. I'm linking different items to the balance sheet, and it's picking them up from different schedules that I've already prepared. We have the debt, we have the non-current liabilities. That was wrong. And right. And this requires the shareholders' equity schedule.